Hi, I'm Jenny Brown and a warm welcome to our weekly buy-to-let mortgage market update. I hope you're incredibly well and looking forward to the football tonight. I might even watch it, you never know. So look, here I am, I'm in the office today, unusually for me. Obviously just great to be in with everybody. We're in 3 out of 5 days per week at the moment. And we're getting tested twice a week in the office as well. So everything's incredibly safe for us. And look, we've got loads of great things to cover off today. There's been lots more changes from the lenders in terms of pricing and criteria. More interestingly, I think, is that what we have seen over the last few weeks is lots of reductions and changing criteria from the more specialist lenders. But now what we're actually seeing is some of the more high street, more vanilla lenders starting to tweak their pricing as well. So lots of great stuff to go through with you today. But before we do that, I also just want to really remind you that we are going to be hosting MFB Live next week. The focus of MFB Live is going to be on limited companies, so limited company borrowing. We're going to be speaking to Roger Morris from One Savings Bank about things from a lending perspective, and also we've got a really amazing tax advisor, Abel, who's going to be joining us to talk about the tax implications of using a limited company or not actually. So please do sign up and come and join us next week. It looks like it's going to be really interesting. The number of people we've had sign up for the event already has been overwhelming, so yeah, it should be a really good event. To do so, please just go to our website. You'll be able to see the details of how to register for MFB Live there. Okay, so first up this week, we have had some repricing from the Principality, who have reduced both their holiday let rates and also their standard buy-to-let rates by up to 21 basis points. So their standard buy-to-let rates are now starting from 1.55%. Holiday lets are starting from a very competitive 3.58%. Now, to access a mortgage with the Principality, I mean, I think it's fair to say they're fairly restricted in terms of what they do. But actually, if you can access their offering, the pricing is really good. So you can have no more than 2 mortgage investment properties in the background. The application has to be in personal names, and you must be earning over £20,000 a year to borrow with the Principality. However, the really good news is they are able to work from projected holiday letting income on the property rather than a notional AST, and they will lend to first-time investors. However, you do have to be a homeowner. So like I say, really good pricing from the Principality. Admittedly, the criteria and their appetite in terms of who they want to lend to is very restricted, but this would still encompass a large number of borrowers. Now, sticking with the holiday let theme for the time being, the Cumberland have added a new holiday let product to their range. So their pricing on fixed rates now starts from 3.84%, so slightly higher than the Principality, but their criteria is definitely broader. So, as an example, there is no maximum age at application. You do have to have £20,000 a year income again. Now, one of the things that I really like about the Cumberland criteria is they're very open about saying that the borrower can actually stay in the property for a restricted number of nights per year. And it's not just a couple, it's a large number of nights, but they're very happy that their borrower will go and use their own holiday property on occasion. And they're also going to work from the projected holiday letting income when they're assessing affordability. Now, they do also consider properties on holiday parks. These properties must be non-movable, so they're not looking at lending on caravans. But if you had, for example, a lodge or a chalet, they can potentially consider these. And Cumberland are able to lend to limited companies as well as individuals. So a really solid offering, slightly more broader in terms of their criteria than the Principality, with the rates not being, much more expensive. Okay, we've seen the Skipton reduce their rates by up to 20 basis points, and their pricing now starts from an incredibly competitive 1.61%. Now, the Skipton are certainly one of our more vanilla lenders. They lend to only individuals, no limited companies. They do want you to have income of £20,000. You can have no more than 10 properties in your portfolio. The background calculation, the rental calculation on the background portfolio is fairly standard, 145% coverage, assuming an interest rate of 4.5%. One of the things that they do is they can consider top slicing. For those of you who aren't familiar with that term, essentially how it works is a lender will apply their normal rental calculation to the property. If there's a shortfall, i.e. the rent isn't quite getting the loan amount that you require, what they can then do is turn to your own personal income, look at how much you're bringing in, how much you're spending, and the kind of surplus income that you have available, and they can then put that towards the deficit sit on the rental calculation, so essentially top up the rental income from your own personal income to try and make the borrowing work. There are other lenders that do this. Skipton are not unique by any stretch of the imagination, but it's great to see with such good pricing they're able to consider this as well. Now, the other thing just to really note is their maximum age at application is age 80. The rest of their offering is very standard, to be honest with you, but like I say, the pricing is incredibly good. Now, BM Solutions have also made some fairly sizable reductions to their pricing, with rates being reduced by up to 35 basis points. So they now have rates starting from 1.38%. Now, what I would say about BM Solutions at the moment is their service is just incredible, like really incredible, particularly for those applications for non-portfolio landlords, those with less than 4 mortgage buy-to-let properties. The reason portfolio landlords is not quite as exciting in terms of the service proposition is because there are more questions that are going to be asked, more forms to be filled out. But we are really, honestly, so impressed with how fast they are at the moment. It's quite something to behold. So look, in terms of who a BM Solutions borrower is, you will be buying or remortgaging in your personal name only. For non-portfolio landlords, there's no minimum income requirement. For portfolio landlords, you need to be earning at least £20,000 per year. You can have no more than 10 properties in your portfolio, and you can be no more than age 75 at application. Now, some other USPs about the offering from BM Solutions: they can do let to buys. They are really good at those flats and properties which are, for example, ex-local authority things over commercial studio flats. With them, what they tend to say is that we don't have a hard and fast rule in terms of, we will lend on an ex-local authority flat as long as it's no more than 8 stories or something. What they do is they really do trust their valuers to advise them as to whether the valuer thinks the property is suitable security. The valuing firm that BM Solutions use is Colliers. So really, in terms of what they will and won't lend on, their offering is very, very broad in the context of the actual property types. But like I say, the service is incredible, and the pricing, particularly after these sizable reductions they've just made, is very, very good. Santander have made some small reductions of up to 7 basis points on their pricing in the last week. The reason I think it's important to really go through all of these lenders is really just to illustrate how you have the real high street institutions now really coming out to play in terms of their rate reductions. So, we've just talked about BM Solutions, the Skipton, and there's been a couple of other really minor adjustments as well. So, for example, Virgin have increased the loan to value. So all their 60% loan to value products are now available to 65% loan to value. So there's really some jostling going on in that end of the market in terms of lenders looking to compete for your business. So look, Santander now have pricing rates from 1.25%. They will lend to people only. You can have, their criteria in terms of the background properties is a little bit confusing. What they say is you can have no more than 10 secured credit commitments. So that could be, you could have 7 buy-to-let mortgages, have taken a further advance on 2 of those, which would then count as a second kind of loan account, which is secured. So that would be 9, plus your own home, that's 10. So it's 10 secured credit commitments, or no more than 10 secured credit commitments to access a mortgage with Santander. Now, they do need you to earn £25,000 a year to access a mortgage with them. If you have more than 5 secured credit commitments, then you need to be earning £50,000 a year. And I think really, if I'm honest with you, this is why we tend to steer away from Santander, because actually their policy in some regards is actually really quite confusing. But like I say, the pricing with rates from 1.25% is incredibly good. So there's definitely a space for them in the market nonetheless. Some other points to note: they can accept applications from those up to the age of 79. They're very, very generous in terms of their lease lengths, so they can accept leases of up to 55 years as a minimum, which is way lower than lots of other lenders. And they do consider things like studio flats, flats over commercial, and non-standard construction subject to valuer's comments. They really do have some neat pieces of lending criteria if you can get beyond the kind of slightly confusing bits that sit around the credit commitments at the outset. Now, in quite exciting news, the Mortgage Works have released some 80% loan-to-value products in the last week. Now, these are available for properties with EPC ratings of A to C only. And the pricing is really competitive in the 80% loan to value space, with rates starting from 2.49%, which honestly is wiping the floor with any of the other 80% rates at the moment. Now, these rates are available to personal borrowers only. The minimum property value is £50,000. There is no minimum income requirement to take a mortgage with the Mortgage Works, and they will lend to anybody who's aged 70 or below at the point of application. You can all have a 35-year term, so essentially their maximum age of maturity of the loan is 105, which I think will cover most of us off, to be fair. And you can have 10 properties in the background. Now look, in terms of these green mortgages and these lenders offering the better rates, as it were, to properties with EPC ratings A to C, I did think, God, how many people is this really going to help out? How many people is it going to benefit? So I actually took it upon myself to do a bit of digging. So look, what I read up is that in the UK there are 29 million homes, and of those, 19 million have an EPC rating of D or below. So that means there are still 10 million homes in the UK who can access these greener mortgages, which is really, really positive. And as we all know, the kind of aim is for us landlords is that by the, in a couple of years' time, we're going to have to have improved our EPC rating to grades A to C. So actually this is really the start of a huge journey for the mortgage lenders. But definitely these lenders are looking to reward those people with higher loan to values, with better interest rates for those people who have the very green properties. The mortgage lender have also made some rate reductions on their portfolio or product set. They now have rates starting from 3.24%. The pricing has essentially come down by 15 basis points. Now, the mortgage lender are able to lend to people or limited companies. They have no maximum number of properties in the background. They're happy to lend on ex-local authority flats over commercial, that kind of stuff. They can also lend on studio flats and first-time landlords. So just a slight rate reduction from TML. What's quite interesting with TML is they've made a series of rate reductions over the last few weeks. I don't know if this is going to be the last one or whether they're going to continue, but they're obviously just going through a period of adjustment, trying to really get the balance right in terms of their offering to the market. Foundation Home Loans have released a new set of green mortgage products which are available to those properties with EPC ratings A to C. Now look, I do genuinely believe that any lender who is pioneering the green mortgage market is to be applauded. I do wonder whether Foundation may have gone slightly too far with this one, because what they've done is introduced a product for EPC rating A, another one for EPC B, and a third one for EPC C, which I think, look, if you're a person who's applying for a mortgage and your property is an EPC rating A, then you're going to be delighted that you're going to get a better rate than someone who's got an EPC rating of C. But I think in terms of kind of, particularly for a broker actually just trying to sort of stay on top and actually understand all the different pricing and how we source on those can be quite complicated. But look, the rates are very good if you have a good EPC rating on your property. The rates start from 1.99%. They're available to 75% loan to value. They're available to individuals and limited companies. Foundation Home Loans have some really flexible criteria. There's no maximum properties in the background, no minimum income requirement. They're good with ex-local authority flats, things over commercial and studios, and they can also lend to first-time landlords. So a really solid offering, and like I said, I don't want to sort of belittle what they're doing. I think it's very, very good, but I think sometimes people, because they're excited to release really nice products, which sound really fantastic from a marketing perspective, actually can really ultimately confuse the market as well. Now, in terms of Foundation Home Loans, they've also made some tweaks to their lending criteria, which encompasses all of their product sets, not just the green ones. So criteria changes were that they have increased the maximum value of the portfolio that you can have with Foundation Home Loans, the amount of debt you can have with Foundation. And they've increased that from £3 million to £5 million. They've also made some changes to how they underwrite portfolio landlords. So they're not asking for proof of income if the rental income for the portfolio covers total mortgage payments at 100%. The rental cover required for the background portfolio is now only 100% coverage. So it was previously 125. So they've really brought down the kind of rental calculation that they're applying to the background portfolio, which is really, really good, because I know some landlords do struggle with this. The total loan to value of the background portfolio, it was previously 80% loan to value. Now your loan to value can be at 100%, which is, really quite punchy. So lots of great criteria changes from Foundation Home Loans. These guys have obviously been very busy in the last week. And our last lender change, Veda Home Loans have made some rate reductions on their fixed fee products. So the fee on this particular product set is £1,995, and the pricing now starts from 3.14% for standard properties and 3.29% for HMOs and multi-units. In the world of Veda, they will lend on HMOs of up to 6 beds and multi-units of up to 6 units. They can lend to limited companies and individuals. They don't mind how many properties you've got in the background. They're doing these rates on purchases and mortgages. You can be 79 at the point of application. There is no minimum income requirement, and they can lend to expats. I think I've been pretty harsh on Veda in the past. They had some really, very, very significant servicing issues, particularly over the winter, which was really, really bad. They've definitely learned from these. They're back up to date in terms of their servicing now, and they're really back in the market looking to lend. Their pricing, particularly in the limited company space, is very, very good. And it's great to see that they've really kind of addressed the challenges that they were facing and have got back on top of them now. So well done to you, Veda. And that is us for this week. Thank you, as always, for joining us. Like I say, we would really love you to come and join us for MFB Live next week. I really do think it's going to be an incredibly useful and informative session. We've had a huge number of sign-ups and actually questions. We've been sent in so many questions already in advance of the event, so we're really looking forward to it, and we'd love to see you there. But until then, as always, if you have any questions, please do give us a call, 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. I will be back this time next week, as always, dearly hoping that we are all victorious in the football. Fingers crossed for England. But yeah, until then, please look after yourselves, stay very, very safe, and I'll catch you next time.